Welcome to Navigating Wealth, a podcast where we apply a high net worth lens to economics, investing, and lifestyle questions. Today, we're thrilled to welcome David Gardner. He's the co-founder of the Motley Fool, host of the Rule Breaker Investing podcast, chairman of the Motley Fool Foundation, and author of the just-released book, Rule Breaker Investing. In today's episode, we cover the greatest hits and biggest misses from David's 30-year career investing in public companies, individual stock picking versus index investing, the counterintuitive math of overpriced stocks delivering exceptional long-term returns, and much more. I hope you enjoy. Welcome back to the Navigating Wealth podcast. I'm your host, Tad Fallows.
Hi, I'm Sriram Gulapalli.
I'm Matt Scheckman.
And we are thrilled to have David Gardner on our podcast today.
I'm fired up for the conversation.
I've had the pleasure to meet him a few times in person here in the DC area, and I think this is going to be a great time. As you all know, we start our podcast with just kind of reviewing some of the recent discussions in the community. And I thought this was particularly apt. There was a discussion a few days ago about how the S&P 500's CAPE ratio has recently surpassed 40 for the second time in history, the first being during the dot-com bubble. And the discussion was more around, effectively market timing. How do we think about, is this different today? And where are we going from here? Personally, I'm unsure. I have a lot of assets in the equity market, as some of you know, and I'll personally admit I've gotten a little bit nervous of late and trying to figure out, I don't want to time the market. Everyone says never time the market, and I'm sure we're going to get into that a little bit here. But at the same time, I do feel like it's a little bit hesitant right now, and I'm wondering if I should start selling more off and saving cash for the future dip that we're expecting to have, if we can time that. But I'd love to hear how you guys are approaching this as well.
Well, so to kick it back to you, Sriram, so you're more concerned now than you were before the dot-com bubble. And now, of course, hindsight is 2020. But if that's the indicator that we're looking at, then now I'm really scared.
Well, I mean, look, the PE ratios are also, are we at a new set of PE ratios as well? Like everyone says it's way too high. And you always see the circular bubbles around the Mag 7 as well. And as we're going to talk about with David, some of these companies are just good companies. They're run really well. So maybe it's not time to panic.
So I guess the couple counter arguments to the PE ratios and CAPE or PE specifically is the companies are different. They have wider moats. They're growing faster. And I think the one that I gravitate to the most is that their margins are exceptionally better, right? That they're better companies. We talked about this a few weeks ago, but if you go back to the top 10 companies in the S&P back in 2000, I wouldn't say that those were bad companies. Like this wasn't pets.com, leading the S&P 500 back then. So I don't know that the just pure company strengths or moats is what gets us there, but the margins and the types of companies being driven and the scalability of their growth is pretty impressive, which gives me a little bit less anxiety, I think, about the valuations. And then I think that there's some stuff around the edges about, interest rates are a little bit lower than they were then, and some sort of expensing mechanisms versus the way CapEx was depreciated then are affecting valuations a little bit. But I'm not adding money to the public markets or the S&P or NASDAQ specifically, but I'm not a net seller either.
I guess for me, it comes down to what game are you playing? And when I think about long angle, I think I'm more about the long than the angle. And so angles are looking at nearer term conditions, and this is a perfectly valid conversation you guys are having. It sounds like it's a continuation of a conversation, and it's a public conversation. There are a lot of people pointing to this and have been talking about how seemingly overvalued the market looks, and or like going to 2025, I think the broad perception was it's going to be a down year because the market's overvalued. So I think this is a continuing conversation, but sticking more with the long than the angle, true to my nature, I really think we're all playing a lifetime investing game. So, and I know one thing, the market historically drops 1 year in 3 and it rises 2 years in 3. And that's why it's great to be an investor and to be long. But I've never pretended to know what's going to happen next. And I think the the strength of that, of course, there's a weakness to it. You endure every bad market, 100% full stop. That's the weakness. But the strength is that when you exit or start softening your allocation into the market, you're going to have to make a future decision to start saying, okay, now I'm going back in again. And a lot of people are gun shy to do that. And then they miss the bounce back, the surprising return of the market, and or they find themselves flummoxed because they've been making decisions around nearer term valuation scenarios. So I just want to say, Sriram, that I think it's perfectly valid. Guys, we may look back on this conversation and say the market was about to get cut in half just months after these guys sat down at the microphone. That could happen. It's happened before. It will happen again at some point. But I truly just don't play that game. And I realize a lot of people who want to retire early, or they have spreadsheets suggesting if they hit a certain number by a certain date, that'll work well. And they want to rejigger their numbers. And you probably do after a great run that this market's had. We probably won't have 5 more straight years up. And so it's totally valid. It's all, I guess, to return to where I started, what game are we playing? And each of us might be playing a slightly different game.
Yeah, I would agree with everything you guys have been saying here. I am with Matt that where I net out is I'm not putting new dollars into the US stock market right now, but also not taking them out aggressively. The thing with the CAPE is I feel like it's a little bit facile. We just take it as, okay, well, this is a fact of life. But, we've got COVID in there dragging down that average profit number. And I don't know why it's inherently more accurate to say that average earnings include a once-in-a-century pandemic versus average earnings or what earnings were last year. I think either one could be a little bit too extreme. So, and the other thing I'd think about is over a very long time sweep, earnings have gone up about 10% a year. So let's say we're at a 30 P to E today. If stocks go sideways for the next 5 years, which wouldn't be catastrophic for investors, well, now you're getting a 50% increase in earnings there, and your P/E goes down to 20 or something like that, and it looks much more reasonable. I don't know that a correction would have to be a cataclysmic correction versus just sideways and kind of pick up your dividend and along the way. The other thought I have is right now in terms of a sort of easier way to address this market is to look at international stocks. Of course, it's going to depend on the market, et cetera. But if you think they're trading at roughly half the P/E of the US and they're much more in line or below their historic averages, I think you're not giving up your equity premium. You could say, well, the US equity market's better and you're giving that US premium. But that to me feels like something you're only saying today. If you look 30 years ago, it was the Japan equity premium and, you're silly to have the money in the US, you should be in Japan. Or you look at China or emerging market, Brazil at certain periods. So I'm less convinced the US will always be the best equity market. So for me, now I will say I've been saying this for the last decade and I've been wrong for the last decade that international seemed like a smart place to invest. But if you take that really long mean reversion hypothesis, that feels like a good way to maintain your equity exposure for new money without buying as much risk of buying into a peak market.
What's your target Colombian bank this week, Tad?
I will tell you, Bank Colombia is up 3x from where I started buying, so I'm still feeling good on that one. Yeah, and there's some sectors too. Like, I'm a perma bull on energy, but if you look at what's interesting there, I don't want to go too deep, but the price that some of those that land is trading on private markets versus buying the same asset through a public major like an Exxon, you can actually get cheaper through some of the public majors. So I think there are even sectors within the U.S. stock market that are not overvalued today.
I think, David, your point is what game are you playing? Because not everybody is playing the same game. And it depends a little bit on your circumstances, too. I think some people would say the game you're playing is the highest financial returns. In my experience and working within long angle, I don't think that that's true. It's people's emotional stability and the ability to sleep and have some certain level of capital preservation. Because especially when you're coming in the game, let's just say with $10 million, the game is different than when you're at one. And so when you hit a certain baseline, that changes a little bit. It also is different if you have a windfall. If you have $5 million that you need to allocate right now, that might be a little bit different than when you're DCAing in and you're just set it and forget it. I'm going to throw it in regardless of where the valuations sit. So, sometimes I'll stick by I'm not a net buyer right now, but I'm not a net seller. I am okay if the market goes up because I'm not selling anything and I'm happy about that. Did I get every extra last dollar in there along the S&P 500 or QQQ? No, but I'm okay. But emotionally, I'm going to be pretty pissed if I throw 7 figures in and 20 or 30% later, I'm looking at it like, man, I sure wish that was in a fixed income bucket or some other asset allocation.
David, this gets a little bit into the, buy low, sell high that I know you infamously have some strong opinions upon. I'd love for you to kind of share some of your kind of experience with that, but also maybe talk specifically about our friend Nvidia. I think you predicted that, or you kind of found all the characteristics with your rules to identify that. I think almost 20 years ago, actually, when I was reading your research. I didn't quite get that. I didn't quite catch it that low, but I'm proud to say that I did catch it around, I think, a roughly 250 is, I think, my basis in, and which I've still held on to most of my position. But now I'm also wondering, like, 5 trillion, like, where do you go from 5 trillion? Like, there must be other good, well-run companies that should have, in theory, a higher chance of doubling, let's say, than going from 5. You just mind-boggling to think of some of these numbers now. Forget about that unit economics, just like the number 5 to 10 trillion. Like, what does that even mean in this scenario? But a lot of questions are there. But David, I'll let you unpack and kind of take it as you see it.
Sure. Well, the buy low, sell high piece, I've said that those are 4 of the most harmful words ever invented that are responsible for incalculable human misery, because for a lot of people who are raised on that mentality, the third word out of their mouth is sell. And when you really think about what we're doing over the course of our lives, we're trying to get on this train as early as we can at the first depot, and it's called the train of compounding returns. And the stock market, miraculously, through every bad period and every good period, averages something like 9, 10, or 11%, depending on when you want to start counting. But the long term, let's just call it 10%. Crazy talk to hop off that train because you think at some point the market's overvalued, even though you're right. And by the way, sometimes the market stays overvalued for 4 years and triples during that time. And you actually left a lot of money on the table because you were right that it was overvalued. And so I just don't play that game. I am DCAing all the time, 100% allocated to equities. I don't actually draw a distinction between US and foreign because I just think it's one planet increasingly. And all I want to find is the best companies that are doing the best things that roll up, Sriram, to sometimes astonishing market caps. And sometimes those are sustainable and sometimes they're not. But I've never been afraid of big numbers. And especially in a world where we're seeing a plate tectonic shift for the second time in the last 30 years. The first one was the other high CAPE ratio, which was, the internet. And while we can look back and think, oh my gosh, dot bomb, what a huge problem that was. Really, having bought a company like Amazon before that and held all the way through and watched my Amazon go from 3 to 95 back down to 7, still holding. Now my cost basis is 16 cents because of stock splits, but it's very, very painful and hard to watch a stock go from 95 to 7, especially when you have paying customers and people who say, David, you loved Amazon. What happened? But the answer is what happened was absolutely amazing because I kind of let it happen over time. So I do think whenever you have a plate tectonic shift, which I think is a generational moment, and artificial intelligence is obviously the next version of that, you're going to end up with stretched valuations at some point. The Gartner hype cycle, for those familiar with the framework, we could talk about it or not, is real. People, start foreseeing what could be before it's practicable. And then valuations get ahead of themselves. But I just keep holding, guys. And so, yeah, my cost basis on Nvidia is also 16 cents. And here's a fun fact. I don't own any Nvidia, and I never have. And I don't actually feel bad about that, although it's, obviously an incredible opportunity cost for me to pay for that. But what I did was I recommended it to Motley Fool members, and I re-recommended it. I re-recommended it again. And I myself was fully allocated at the time, and I love a few hundred baggers that I own as stock. So I don't really feel a need. There's no FOMO for me missing Nvidia because I didn't miss it. I actually called it. I just didn't allocate toward it. But, these are the great companies of our time. Sriram, these are rule breakers. These are the Davids that beat the Goliaths. That's always what I'm on the hunt for. That's what my book is about. That's in some ways why I get invited on the podcast to discuss, how do you find the next Nvidia? What are the pattern recognitions that we gain around the world-beating stocks that shape the future? That's really where I spend my time. Admittedly, I'm not so great on CAPE ratio, and I'm the guy who's still holding the bag at the top and then all the way back down, and I'm still holding then. And it actually works. So I'm not a driven by fear investor, and I don't worry about protecting past gains. I'm just always allocating, always be buying, always looking for greatness. And I hope that answer wasn't too long.
And David, just to follow up on that, I don't think anybody could consider Nvidia a David today. So not David Gardner, but a David versus Goliath.
Yeah.
So the question is, maybe to build on Sriram's, would you still be buying that today? Or are you saying, hey, we are looking for the next Nvidia, but that has to be a $5 or a $10 billion company. It can't be
question,
a $500
Tad.
billion company.
Yeah, that is a great question, Tad. And my answer back would be basically both and. So I do think that Nvidia is in a beautiful position. One of the simple tests that I've always kind of performed in my mind to help me think about which stocks I want to keep holding or even add to. And by the way, most people like Sriram who've owned Nvidia don't need to add more here. They're probably overweighted in it. Anytime you have a stock going up 100, let alone more than 1,000 times in value now since our original cost basis, you don't need to add more Nvidia. But so I think we'd be speaking to people who don't own Nvidia, or maybe don't have a full position, or are wondering at a $5 trillion market cap, is this the right place for me to put dollars? So I would say, Tad, that obviously you're not going to see a 100-time return on Nvidia ever again. I mean, you will if you can manage to live another 400 years, but that doesn't happen from this kind of size. So you're absolutely right to say, should we have that? And the test that I love performing is my snap test and my cola test. Here they are really briefly. Snap test is with Thanos from Marvel Comics fame. If you snapped your fingers and the company disappeared overnight, the stock that you're researching, that Colombian bank, would anyone notice? Would anyone care? And I can't speak to the Colombian bank, which I don't know, but I've always been rewarded for being guided by making sure that lots of people would notice, and many people would be heartbroken if the company that I'm researching or own shares in disappeared overnight. So that's the snap test. And then the cola test is, you found Coca-Cola, just to use a metaphor. Do you see Pepsi out there for what this company is doing in the world? Is there a Pepsi to that company's Coke? So when I think about Nvidia by the snap cola test, the combo of those two tests, I say it is an incredibly powerful position of agency and possibility. And obviously there's some questions around, like, they're funding people to buy their stuff, and there's a lot of cross trading at this period in history. But anyway, Tad, I love Nvidia here, and yet I understand that it would be more about probably getting paid future dividends than any big appreciation, although I still think it's a market beater. And I do love finding the next ones. I love finding small to mid cap companies. That's really where most of our reward's going to come, not from buying Nvidia or Apple today.
And I think maybe just one last question along these lines. There's probably two questions you could ask. One is just through starting, hey, 5 trillion is such a big number that you can't 100x 5 trillion. The other one is more of this entry P/E multiple. And when you're looking at a company, do you basically say, hey, I just want a great company and I don't care what it costs because ultimately it'll grow into almost any valuation? Or do you really look at, hey, there is some price at which nothing is worth that. And so anything, Palantir is a great company, but it's trading at 100 times revenue. Nothing's worth 100 times revenue. How do you think about that?
Yeah, I'm more the former than the latter, Tad, but I'm really glad you mentioned this, because this is one of my favorite topics. And maybe my favorite chapter in my book is chapter 12, which is entitled, in quotes, Overvalued. Because there's something being missed when people look at traditional valuation. And I think that this has been, if I have secret sauce to share here, I think this might be the true essence of it. Because what's been happening is people are valuing stocks off of earnings, price to earnings ratio, or cash flow, multiple of cash flow, or maybe book value for some contexts. And we're actually missing all the things that are not captured by that are in many ways inputs that create that output, that are more powerful and more important than whatever last quarter's earnings are or next year's cash flow is. And I'll give you two quick examples. The first is, who's running the company. There is no line in the financial statements expressing the value of the CEO. Some of them are unbelievably valuable, Jeff Bezos. Some of them are negative. There are definitely CEOs out there, maybe you know a few, maybe you have a few in your portfolio, that are actually costing their business, that are hurting the performance of that stock because of the beliefs, inadequacies, or comportment of the person leading the enterprise. I really started getting in touch with this insight when I started my own business, the Motley Fool. And I started seeing from an entrepreneur's viewpoint what it takes to scale something and grow something, the strengths and the weaknesses of things. And so, guys, there's no line for Elon Musk. It's just generic CEO. It's just a monkey running the business, as Buffett might joke. That is probably the single most important factor behind what stocks are going to win and what are not. And our valuation methodologies don't notice it. Here's another quick example: the brand.
Well, wait,
Brands
hold
of
on,
companies.
David.
Oh,
can
sure,
you back
sure.
up there?
Yeah.
So how do you evaluate the CEO?
Yeah,
Because I know
so
for a lot of people who maybe are looking at individual stock, they're like, oh, I know who Elon Musk is, or I know who Alex Karp is, but maybe they don't. I actually couldn't tell you who the CEO of Coca-Cola is right now. So
nor could
how
I,
do
but
you
in part
think
because I
about
don't know
that in
Coke.
terms of a diligence? Yeah.
Yeah. Well, first of all, I think it's something that we have more information than we ever had before. So I did grow up in a time pre-internet where stock research amounted to getting the investor relations number and having the annual report mailed to you. Now we have YouTube videos that you can watch somebody speak for 45 minutes, who's the person running that company or the next in succession. So I would say we have an unprecedented ability to study and learn about the people that are running businesses. I favor youthful people. I favor people who are ambitious. I favor people who are deliver and a combination of these things. The visionaries typically often map the founders of companies. These are the people that have been my best stocks. I don't think it's a surprise that Musk is behind Tesla, Bezos is behind Amazon, people like Howard Schultz behind Starbucks. I mean, this matters deeply to me. I also would say, this sounds old school too, character matters a huge amount to me. So I really want to believe in the person. Some people think that Elon Musk is the worst person on earth. Other people think that he is the most amazing person ever born. I'm somewhere in the middle, tending toward being pro Elon, but I'm not a crazy fanboy. But I think it deeply, deeply matters who's running our companies, who starts our companies. And Matt, there's no single factor we can do. Unless somebody, by the way, some bright, long angle fan and listener, maybe one of you guys already has something in place. We should be creating a numerical proxy if we want to be firmly numerical with our valuations. If we want to take out our valuations to a second decimal, then we absolutely should be creating a proxy for the value of the CEO. And it's not going to be 0 to 100, because there are some CEOs that are worth 10,000 in a traditional 0 to 100 framework. And I've seen it real time, and I've bought and held their stocks. So I'm just here to say I believe in the Superman view of history. And was it Nietzsche or somebody? I think that there are remarkable people. And in fact, I think they're entrepreneurs usually. And they're the ones who see what we didn't see. In my book, I quote Arthur Schopenhauer, the 19th century German philosopher. This is one of my favorite lines. Talent hits a target no one else can hit. Genius hits a target no one else can see. And I've seen this firsthand now for entrepreneurs who do this, and we want to get invested in them. So to Tad's earlier question, it almost doesn't matter what your valuation is. Like even Amazon at 95, just before everything fell apart in 2001, is such a tiny cost basis today in Amazon. It mattered much more your buy discipline than a world that seems focused on so-called sell discipline, as if that's the biggest, most important thing. So obviously you're talking to a rule breaker today. I like to challenge assumptions, but these are some of the things that I think. And Matt, I hope I don't sound too self-confident, because I'm a fool. I am actually picking more bad stocks than most people I know. And I'm comfortable with that because I believe losing to win is the best, easiest way for me to do it. There's some, Rule Breaker 101, throwing down some phrasing and thoughts.
David, question for you on your idea of CEO. For those of us who are maybe not as, growth at any price oriented, a little more value investors, is there a way to take that nugget of CEO and say, hey, what if you put your filter somebody who has been an excellent CEO somewhere else and now takes on a second company that's trading at a reasonable price? And there's not a million of these, but like Larry Culp at GE springs to mind. He absolutely blew the doors off of Danaher for years and years, takes over GE at a low price, and then it's up 5x since he took over. That seems to me maybe the best risk return, where you don't have to believe that you're coming in at 100x multiple, but you give yourself that opportunity that if there is a great guy in charge, you can ride that tailwind.
Yeah, I think that's cool, Tad. And, let me just say, overall, what you and I are both saying is that who's running this thing matters. And where is that in the valuation methodologies taught in business school to investors, et cetera, quoted all the time? I don't see it. Hidden in plain sight. So when I'm saying I'm trying to throw out secret sauce, this is based on my 40 years of personal investing and just sort of what I've seen. Because I was the guy there saying I believed in Jeff Bezos, or I was, being interviewed on CNN. Coming back, we're going to have the guy who thinks you will use your credit card over the internet back after this. Like crazy talk that e-commerce would actually work, right? So I've seen extreme skepticism in the face of innovation, and I'm always going to side with innovation. And like a venture capitalist, I'm willing to be wrong and look silly and airball it from the free throw line 10 times in a row, because that 11th, if it's Amazon or Nvidia, it makes you forget everything else. So, I want to say yes. You and I are both saying people matter. And I'm saying if we do believe that, where's that in our valuations? People tend to look at young CEOs and think they're crazy and it'll never work out. Like Elon Musk is a crazy man for these electric cars. Who Killed the Electric Car was a show on Netflix just before Tesla started launching. So I also just want to throw in really quick, because Matt halted me, and rightly so, saying, "Hey, how do you score these guys?" And by the way, they're not all guys. In fact, I have a real bias toward female CEOs because it's very hard to get to a point as a woman of some of running these kinds of companies, Lisa Su. So these are usually remarkable people that you want to pay attention to. But a second one, by the way, I have 4. I'm not going to do it because it would be too boring and too long a podcast, but I have a second quick one hidden in plain sight that's not being factored in anybody's valuation typically, and that's brand. As I mentioned very briefly, brands are unbelievably powerful, sustainable competitive advantages. And the value of a Chick-fil-A brand, the value of the most valuable brand in the world, Apple, these are not expressed in financial statements. And so when people say, oh, that stock is so overvalued, they're not including the value of the brand, because unless somebody overpaid for somebody else's company and calls it goodwill on the balance sheet, there is no measure for brands. So we've just said we're not scoring who's running the company, and we're not actually including brands in our valuation. And so I would say maybe we can't, although maybe some bright person listening to us will figure out how to do this in the next generation of investing, because if we're going to be serious about saying stocks are overvalued or this or that stock's valuation is this, and we're not looking at the real inputs that create the remarkable results, I think we're missing something big. And I've been taking advantage of that for 30 plus years now. And by the way, I want to say again, I'm also the guy who picked Peloton, who picked GoPro, who picked 3D Systems, stocks where I saw the same patterns, but it didn't work out. I ended up going, darn it, I guess Peloton was more about the pandemic than I thought. So I'm totally willing to be wrong and look silly, because I know the benefits of being right half the time.
So David, on brand, then if we can double click a little bit on how you're thinking about this, is it that you don't feel like there's a separate quantitative measure? I feel like somebody would probably say, yeah, I guess that's true. There isn't a line item for brand. Although if you equate that to pricing power, moat, margin, then I'm just going to pay a higher PE, and it's built into essentially the underwriting assumptions that I'm doing. So your sell side analyst would be like, yeah, I mean, I've got that covered. But is it more on your end of that should be a very specific thing that you are quantifying against other apples to apples comparisons in terms of, making these decisions?
Another great question, Matt. Thank you. I do think, obviously, brand and even who's running the company are implicit in various numbers. But my experience is that I'm talking to spreadsheet people who don't necessarily have an entrepreneurial view of things. They work, everything's a math problem for them. And they're not actually working within businesses and seeing how these things play out. So if we're expressing brand as higher pricing, which I think is true, and therefore better margins, which I think is true, that is essentially an income statement view of brand. Brand is an unbelievable asset. Brand is something to rally around in dark times. Brand is something that causes you to knock out your competitors. That can't be fully expressed in a single line of somebody's spreadsheet for the margins for the upcoming year, right? So I think these things tend to be minimized because they're trivialized because we're trying to express them as numbers. And I think one of the key lines in my book is there are no numbers for the things that matter most. And there are other things too. I said there are 4. I might as well just throw out the other 2. And not for discussion, unless you guys want to, but just for observation. 2 more things that I've learned matter deeply and are not being captured in financials. The innovative power of a company. Some companies are incredible innovators and some are not. And I actually think that's probably as or more important than who's running the company or the brand. And, we see it with companies. Like you can try to express R&D as a percent of revenues, let's say. And so you're like, the problem is that Nokia was running a higher R&D as percent of revenues than Apple at a much higher scale, and Apple invented the iPhone. And kind of knocked Nokia out. Go ahead, please.
And can I ask you a question on that one, David? It's not to challenge that being important, but in terms of how sustainable do you think that is? Because if you think of any company that became big, like a Eastman Kodak, they were innovative at one point, and then their problem is they stopped being innovative. And so, and maybe Apple, we could argue about, well, was it all the stuff, we're still just coasting on what Steve Jobs invented and the rest is just execution? And are they no longer innovative, or are the AirPods the next big thing? So how do you think about the sustainability if you separate it from the CEO or, the Johnny Ive or something?
Yeah, well, thank you. And first of all, I just think that's a great question. Like, that's the kind of question we should be asking, more so than how do I fill in cell number C17 on my spreadsheet for 3 years from now? So to me, that's the right question. And obviously, there are multiple answers to that question. We have seen companies consistently deliver. Amazon is an unbelievable capital I innovator across multiple generations and multiple categories. And so I would say they're not Eastman Kodak. And in my lifetime, maybe yours too, I've watched Eastman Kodak implode. That was Eastman Kodak. And there are a lot of companies that are somewhere on that spectrum between those two examples. And we should be paying attention to that. That's the right question. So by no means does it mean anybody's bulletproof. And we're living at a time where new technologies are being invented at a more rapid pace than ever before, which makes assumptions around moats or sustainability of technological advantage harder to quantify, harder to know. And it's the right question to be asking. And the innovative capability of companies matters very deeply to their future, and we're not really scoring that with our valuation methodologies. And the fourth one, which connects to all three of these really, is culture. I think the corporate culture matters very, very deeply. It's almost never asked about, discussed. It's not factored in. With that, we could say, well, it's there in some of the numbers if you look at it. Like, for example, loyal corporate cultures have lower turnover and therefore deeper institutional memories with more employees who get it. Which are the companies that tend to outperform? The ones that are the best to work for. There's a reason that I sure wish Chick-fil-A had been a public company all the way through. It remains private, but I would have been owning it all the way through, because sometimes it's described as a leadership academy masquerading as a chicken joint. I love those kinds of companies. And Apple's culture is much bigger than Steve Jobs, which is why he can be succeeded by somebody who's created more gross market value than Jobs created. And so corporate culture matters extremely deeply, and it's not being factored in. So hidden in plain sight, who's running the company, the brands the company has, their innovative capability, and certainly their culture. And those are the things that matter most to me. And I've watched it in my own company when we do it well, and when we don't do it, I know how important it is. It's not being factored in. So I actually think a lot of long angle listeners already get this, because we've got a lot of business people here. We got a lot of entrepreneurs, people who have created their own value. They see these things. I just don't traditionally hear it on quarterly earnings conference calls, which is, in some senses, without being snarky, what I've been taking advantage of for a few decades now, because I think these things are being missed. And to bring it all together then, guys, all the best companies, chapter 12 of my book, look overvalued, because all the best companies have the best factors along those four dynamics we just talked about, and none of them being factored in valuation multiples. So Starbucks has always been overvalued. Why would you pay so much for coffee, et cetera? So this is, like, to me, one of the key insights I've come up with my whole life. And it may change if people start factoring in new proxies for these things and have a deeper, better understanding of what really wins in business over the long term and the stocks that we want to own.
You mentioned privates there a little bit. You alluded to that and missing the opportunity to invest in Chick-fil-A. With more and more companies, it seems like anyway, at least in my 25 years of being an investor, so to speak, we're seeing more and more companies stay private. I think the most recent largest one at the time of this podcast is OpenAI, for example. What's been your approach? I think I know the part of the answer to this, but both accessing privates at all as part of your portfolio, just generically as an asset class, as well as your perspective to companies staying private.
Well, first of all, I'm frustrated when companies roll up to 12-figure valuations and we never had a shot as individual investors. It's their prerogative. So, and a lot of CEOs would prefer to stay private. They're like, don't want to have to deal with all the public stress and the short-term expectations and all of that. It's a mess. And so they just stay private. And we don't have to buy their stocks when they come public. There's an assumption that everyone's going to buy OpenAI when it comes public because, wow. But we've already been talking about, guys, if you're already at $1 trillion multiple, like how awesome is that stock going to be over the next 20 years? And the answer is I would never put it past a great plate tectonic kind of a company like Amazon or OpenAI to still kill it beyond the numbers we ever would imagine. And I don't have to buy their stock at the IPO. So I think my little way, and this is just a little thing because individual investors are a small part of the market, but a big thing for me because that's what I am. We don't have to buy the stocks when they come public. I'm not going to get caught up in the hype. There are so many great companies I already see. A company like Intuitive Surgical, which is one of my favorite companies over the last 20 years, been a monster winner for me, 100+ bagger. Most people don't, if you tackle them at a cocktail party or bus stop, they've never heard of Intuitive Surgical, but they sure have heard of ChatGPT and OpenAI. So I can find great companies that are lesser known and probably provide better opportunities. But I'm also never going to gainsay great companies coming public. Airbnb, Uber, these are companies 15 years after the internet showed up that all of a sudden became public, which is a great reminder to us with AI that there are going to be unbelievable companies showing up in 10 years that we don't even know about yet. Because when plate tectonic shifts happen, they create new possibilities. So we're still so early on. Everyone just thinks of one company, and that company has moved from not-for-profit status to for-profit status, raised a ton of money, and I probably won't buy their stock at the IPO because there's too many other interesting companies that I think have better prospects, even though deep respect for what they're doing. And so that, Sriram, is like, you also, obviously, you're speaking to an audience that does have access to private markets relative to many other people. And so I would say, go ahead and take advantage of it and have fun. And I think venture capital is one of the best businesses of all time. I love it. I'm also not very good at it. I've discovered whenever I try to be an angel investor or take a board seat on some small private company that I think is going to go to the moon, I'm kind of wrong. And so I have also had friends who say, well, David, how often have you actually done that? And I'll say, 5, 10 times. Like, imagine if you're saying after stocks, like you bought your first 5 or 10 stocks and it didn't do that well for you. Are you like, I can't be a stock market investor? So the truth is, I'm not really doing it in any meaningful volume to score myself in a way that's meaningful. And I find it so much easier and lazier in the best way to just enjoy my public market companies and the opportunities presented by them. So Sriram, as a consequence, I'm not that active there, but I'm there saying, at a fool, at a boy, at a girl, to anybody else who wants to go there in the private markets, because I think it's really cool. It's very vital.
So to clarify that, I think you're 100% U.S. equities or something like that. Is that right?
Pretty much all the time. Although I will also say, and this repeats something I said half an hour ago, but I don't actually draw a distinction between U.S. and non-U.S. And I really do believe the U.S. is the place to be, has been the place to be, and continues to be the place to be, because I'm looking at where the entrepreneurs show up and create things that they can own and scale. And most of the places that are the opposite of the U.S., the really poorest, worst regions in the world, are places where entrepreneurs have no shot at all at solving the problems of their communities or their countries. So, and while China is very impressive to me, I don't believe China is building trust worldwide. And I think trust is the coin of the realm with George Shultz, that starts to veer out of investing and just thinks about life in the world. But I think the U.S. remains the place to be. And I love Mercado Libre. I love my non-U.S. stocks that have been 100 baggers for me. They could show up anywhere. Let's just let them happen. And if they can't happen in certain areas of the world, I probably won't invest there.
So, David, then I think a lot of the things that you're mentioning are things that people are not thinking about enough. And you can call them qualitative factors or things that we're just not quantifying. And they make sense when the world is linear, right? But there are so many pit stops along the way. If you take Amazon or anything else, that on any given basis, you might be able to look at and say, well, I don't know, the world is changing. You have, look at Starbucks CEO departure, and then how much of a brand moat do they have, and store closures and culture when they're fighting unions and things like that. What does that look like? How do you think through getting through some of these hiccups on those qualitative factors? And you could probably even apply that on a macro basis, right? US over the last, call it 100 years or so through the Industrial Revolution has been the place to invest and innovate. how do you think about that when the rule of law is under question or our debt levels are becoming unsustainable and things like that? In hindsight, I think all of this stuff is easy. When you're in it, I think it's hard to evaluate which signals are maybe quantifiable changes where this brand, this CEO, this culture are no longer moving in the direction that I want. And people are momentum beings, right? Like they can kind of go through it and it's hard to change course. How do you think about selling a country or a stock or anything?
Well, thank you, Matt. First of all, great question, because everything does, in the end, have a life cycle. Not everything works all the time. Not every stock can be held to the moon. Starbucks is more challenged today, certainly, than it was 10 or 20 or 30 years ago. And we've also seen companies last longer than that and do amazing things. I would say Apple is an incredible example. When I first bought Apple, it was 2008, and I felt like I was so late. iPod was already out, iPhone was out the year before. I'd grown up watching, Jobs, etc. And I mean, it's been a phenomenal performer just since 2008. I think it's up maybe 50 times in value. So everything has a different life cycle. And so it's very hard to generalize and say this country, this context is going to play out like all the others. So I would just say, Matt, you're right. Looking backwards, it looks easy to say that the U.S. was the place to be. I also do want to say, though, on my behalf, and probably yours too, let's take some credit, because I was invested all the way through. And I was hearing skeptics from doubting of e-commerce all the way through saying, bad time to be in, et cetera. And by the way, generationally, once every 10 years, they're right. 2008, 9, horrible. Never expected COVID. And so, I mean, let's recognize that, yes, hindsight can be 20/20. And yet, at the age of 59, I've now lived through 40 years of being fully invested in all the lessons that I've learned from that. I would just say that a lot of investing comes down to like how big is an idea or how big is an opportunity. So it's TAM, it's total addressable market in a lot of ways, Matt. So, I think that if I'm looking at very small cap companies in, let's go with a foreign small cap fund, I probably need to be a tighter rein with a more specific view of what I think is going to happen in that country over a given period of time than saying Amazon. And I prefer to say Amazon. I prefer to look for the rule breakers, the ones that are top dogs and first movers in important emerging industries. You also were referencing not just individual companies, but countries, or just contexts. And I guess in my strength is my weakness, because for me, I'm a bottoms-up person. I don't feel pressure to have the markets figured out or the world figured out or a given region or a given time. I really am just asking, what's a great company? I love researching stocks. I love meeting people. I love thinking about new technologies. I'm always an early adopter, so I have a whole closet full of tech items that I bought that didn't work out. And that's true of tech stocks that I bought that didn't work out. By the way, tech stock is not a phrase I ever used. That was almost a mistake, because I'm cynical about people who think there's technology stocks, because that doesn't mean anything to me. But anyway, so I think that, we have to ask contextual questions, Matt, and say, is that opportunity as big as we think, et cetera. But as a bottoms-up person, Warren Buffett has a great line. In fact, it's on page 16 of my book. I'm quoting somebody else that you guys have heard of. Here's the line. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Period. End quote. Mic drop. Warren Buffett. So, and I'm not being cynical about the geniuses who are making market calls or the people who ask big questions like, is this a time to be invested or not? I mean, I think that's a great question, but I am also saying that that's not my style. I don't feel pressure to have answers for each region, US versus foreign, this 5-year period versus the next one, because I'm much more interested in just finding great companies and adding them to my portfolio. And they sometimes crop up in bear markets even. But I hope that was not a long non-answer to your question, Matt. I value the question.
Not at all. I think it just depends a little bit on in a specific investor's proclivities, because
what game you're playing, right?
Yeah, exactly.
Yeah. So for this particular podcast, you invited on a rule breaker who's playing a long game and is a bottoms-up investor looking for great companies in a world where I feel like they're being misvalued. And it's not just a feeling. It's literally that my 7 100-plus baggers that I picked for Motley Fool members are these companies. And every one of them was overvalued when I bought it. Intuitive Surgical, I referenced briefly earlier, 71 times earnings when I picked it in 2005. But I looked at my SNAP test and my COLA test, and I said, I don't see anybody else at scale doing minimally invasive robot-assisted surgery. And these days, up more than 100 times in value, Intuitive is basically, they have a larger R&D budget than any but competitors' sales line, top line of revenues. And I don't see anybody catching them anytime soon. So these are the companies that I'm looking for. And guys, it doesn't take 7. Sometimes it just takes 1 or 2 to float a whole portfolio. And, you're selling off that thing as it goes up because it keeps breaking all the parameters that you would feel safe with having your largest holding invested in X, whether X is Apple, Intuitive Surgical, Mercado Libre, Tesla, Amazon, the list goes on of the great companies of this generation.
So maybe to build on Matt's question there, he's saying don't make macro bets. The circle I'm trying to square here is if you do look at something like Dimensional Fund Advisors, who says, hey, if you take 100 years of history, value consistently on average beats growth stocks by say 4% a year. And now, goes up a lot and down a lot year to year, but on average, you get better returns buying stuff where you have a low entry PE rather than a high entry. And then I'm comparing that to you saying, hey, look at my actual track record. My actual track record is I've been able to beat the S&P. And so I don't care what, average says, these are above. How do you square those two? Is it just, hey, I've been particularly good at picking growth stocks, or is there something else about like, hey, there's a bunch of trash growth stocks that are overpriced and it's about being more selective, or how do you think about it?
It's a great question, Tad. And I want to, again, not try to sound like I have an answer to everything, right? So I hope I'm not sounding cocksure. Please know I come from a place of humility. I am a capital F fool, and I'm just sharing what I've done that's worked over the course of my life. But I have done it in front of a lot of people, with a lot of people who are like, investing alongside me going, okay, David, I'm with you there. And it really has worked. So I'm not going to stand in the face of academia or, 100 years that say that. But what I will do, Tad, is I will reframe things sometimes. You will not ever hear me say growth stock or value stock. I actually don't really know what those are. I think of stocks, equities. I could say, you've also heard me say I'm not a U.S. foreign equity person. We're here on planet Earth. I'm looking at companies. You can call them a value thing or growth thing. And you're using, I assume, I don't mean you personally, I just mean you, world at large. You're using some form of numbers to quickly categorize things. I would be right away scrutinizing what are the categories? How are we defining things? For me, I don't feel a need to own growth stocks. I don't think that I do own growth stocks. What I do feel a need to find is excellence. I'm looking for the top dogs and first movers in important emerging industries with a sustainable competitive advantage, stellar past price appreciation, good management, smart backing, strong consumer appeal, and that are broadly perceived to be, this is my special sauce, to be overvalued by the world at large. I want people to say that Amazon's so overvalued. Like that is the ultimate buy signal for me. Are those growth stocks? Are those different from value stocks? What is a value stock? Without trying to go into an academic discussion, I will also say I'm very comfortable disagreeing with academics because I've also grown up in a world where, this is the world we've all grown up in, where we're regularly told that it would just be luck to beat the stock market averages. It's not possible to do. All you should ever do is index because it's monkeys throwing darts blind at a dartboard. They have just as good a shot at beating the market as you and I do. I completely disagree with that. I disagreed with it when I was 18 and started investing with a portfolio my dad handed me. And when we started the Motley Fool on day one, we're like, watch us. We're going to invest right out front of you with our own real money. We think this is the great canard of our time, that it would just be luck to beat the market averages. Nobody says that for any other discipline, from doctors to NBA players, that it's just luck to be better than average. But people honestly at scale, thanks to academia, have become convinced that that is true. And you guys may say, well, I don't actually believe that's true. And here we are having a conversation about investing. So I assume you probably don't believe that's true, but just know that is the conventional wisdom of our time. And it's powered Vanguard, who I love, and Jack Bogle, I love. I just think it's wrong. And when everybody starts agreeing with the conventional wisdom, the fool in me starts going the other direction. So I'm very comfortable disagreeing with academics So Tad, back to 4 percentage point value stocks outperform growth stocks. Not really sure what we're talking about here. I'm not owning all of them, either category. I don't even think those are the right categories. I'm just going for excellence. And let's buy the great companies and hold them. And be wrong, by the way. Let me give a fun fact. This is a sad and fun fact, and I'll keep it quick because I think I'm nearing rant status at this point in this beautiful conversation that I've had a lot of fun with. But this is really helpful mathematically because we have a lot of math people listening. So I no longer pick stocks at the Motley Fool. I retired 4 years ago from that after 30 years of doing it. And I wrote my book, Rule Breaker Investing, which just came out a month ago. That's when I first met Sriram discussing that. And so that's where I've settled in. And I want you to know that at one point near the end of my career for our Motley Fool Rule Breaker service, I calculated that I had picked 363 stocks, 389 stocks. That's 2 a month for years and years and years, looking for rule breakers. And here's the horrible, horrible fact. Of my 389, 63 of them were down 50% or more. I am a professional. People are paying me for my advice. I'm saying buy this stock, and literally 1 in 6 of my picks lost 50% or more. Horrific. And the third best pick was up 402%. It was HubSpot, for the record. It's now up more than that. That's the third best pick. So if you're still being mathematical with me, I hope you're seeing what's happening here. We've got 60 or so picks, somewhere around, we'll say the average minus 75. But the third best is plus 402. The best was Tesla, up over 100 times in value. Tesla on its own literally wipes out all of those 63 minus 50% plusers on its own and leaves money on the table. And in between Tesla and HubSpot were 61 other stocks that had gone up 5 to 100 times in value. And so the math of it is, in a world where we're told it would just be luck to beat the market, usually by academics who are looking at short-term timeframes saying, well, he was right that year, but the year after he didn't, so you can't keep beating the market every year. We're not actually asking the right questions. We're not framing things up, a whole life, holistic way of viewing investing, and we're not admiring compounding, which is what people love about Buffett, and I hope rule breaker investing, that much of the world misses. So I'm here to say that I think a lot of the ways people frame things up are improper. It starts with buy low, sell high, in my opinion. And as a rule breaker, there's a lot of other things besides. But I really wanted to tell that story because I want to make it clear how often I've lost and how willing I am, in a way probably many of our listeners wouldn't be. And much power to them, because we should all be following the beat of our own drum. And getting to know yourself over the course of your life is one of our biggest challenges anyway. Know thyself was on the Oracle at Delphi, scrawled on the side, know thyself. So we need to know ourselves. But for me, I am willing to lose and look silly, even publicly, and to try to learn from that as we go. But when we win, this is the key, guys. You're capped at a minus 100 downside. There is no cap to upside. But humans are hardwired to fear loss. And so we end up, torquing ourselves and losing the opportunity to compound with great companies because we're asking the wrong questions or following the wrong dictums, in my opinion. Doesn't work for every stock, by the way. I'm speaking to a very qualified class of stocks, the rule breakers, right? There are cyclical stocks. There are companies that you wouldn't want to add to on the way down. I never do add to stocks on the way down. I only add to my winners. So there are a number of prescriptive approaches that I think are very rule breakery that we're not necessarily speaking to. So in case I sound like a crazy man to some people, please know there's more context than we necessarily covered here, because we're talking about a special class of companies, the ones you and I think should be invested in a world where there's so much mediocrity, so many also-rans, so many short-term games being played. We're looking not at that. We're playing a different game, as I think we started this whole conversation with. What game are you playing?
And I think I heard you say this, but I'm not entirely sure. So does that also mean that you don't really hold any indices, any mutual funds that are broad market indices? And then a follow-up question to that is, when you're actively picking, which sounds like you may be less so now, how many single equity positions do you have?
Both excellent questions, Sriram. So yes, I actually do have an index fund because at work, when we started our 401k at the Motley Fool 30 plus years ago, you couldn't have individual stocks. And I've just kept indexing my 401k. It's a small part of my overall wealth, but I have an index fund. And by the way, the Motley Fool has been a big proponent and fan of index funds. You'll see in our first book, The Motley Fool Investment Guide, we're like, you should own index funds, not manage mutual funds, right? So I want to make it very clear, speaking out both sides of my mouth, I think indexing is great for a lot of people. And I think for those who are intellectually curious, who actually want to win, who think life is an adventure, not just a math problem that they don't want to have to deal with, but they have to retire someday, so they have to check a box on their 401k. For people who love this and are probably listening to us right now, I don't think you need to index at all. And I wouldn't have, other than that one example. So I don't own any other mutual funds and ETFs. And yet the Motley Fool has ETFs that I can't talk about because that's a regulated side of our business. So I'm just saying, I think there are a lot of tools out there, and everybody should make use of which tools in their toolbox. To Matt's earlier point, we're talking about what game are you playing? We're all kind of playing different games. So I'd be the first to say, for some people, you should make broad use of that, or very specific forensic use of ETFs. Let's say in some context, like you don't want to have to figure out, as Tad has, Columbia. You just want to own Columbia, then go for it. There's probably a Colombian diversified ETF for you, and I think that's just fine. Then your other question, Sriram, about how many stocks, how many investments, there's a simple concept that I introduced in my book, half humorously, but half seriously. And it's just that whatever your age is, that's roughly how many investments you should have. Again, I run a podcast every week where I get questions sometimes from starting investors who are like, what's the right number of stocks in my portfolio? And it's a very common FAQ kind of like question. And my answer is always, that's the wrong question. I mean, there is no right answer to that question because everybody's different, and some combination of your risk tolerance, number of years to retirement, expectations, interest levels, all of these should factor in. And if you want a simple answer, what's your age? Great. That. So for me, I'm 59. I think I have about 55 stocks. I'm not trying to hew to any given number, but that gives you a sense of things. I'm definitely over-concentrated in my biggest holdings. And that's another little chapter in my book where I introduce the sleep number, a concept stolen from the mattress industry. And just to spoiler alert that one right now, so anybody can skip my book and not read it and know what I'm thinking. Your sleep number is what percentage you would allow your largest holding to become of your overall portfolio and still sleep at night. And so one of the things I encourage my fellow rule breaker investors to do is to think about, establish ahead of time, what is your sleep number? Which, by the way, is a number that can change at different places in your life. But I have a very high sleep number, i.e. I am willing to let a stock become 50% or more of my portfolio, a single stock, and still sleep at night. A lot of fellow Americans, it's about 1, not 50, because they're broadly diversified. And if anything was more than 1% of their portfolio, they would start to lose sleep at night. A lot of investment clubs, I've been in one of those, usually have like 10. Like if a stock becomes 10% of the club's portfolio, they're like, raise my hand, we need to sell that thing down, rebalance. So I'm not here to say the right answer is any number. I'm here to say it's the right question, and you should commit to it ahead of time so that when you arrive at that place, you remember, oh yeah, that's right, honey. I said never more than 20. And so let's go ahead and sell that because it looks like you're losing sleep at night, even if I'm not, which is a reminder, investing is a team sport. And that the best relationships in our lives are going to be when we're both aligned. Not one of us is the crazy man doing stuff with their money and the other's wondering what's going on. But that's a separate topic.
That's a separate topic.
Yeah,
no, it's great. David, we're very fortunate to have David with us for long angle members. I think next week, in fact. Where we're going to dive into.
Let's be non-duplicative, Sriram.
Yeah, no, we're going to be diving into. It'll be all new stuff. Trust me. I'm going to go more on the. We'll go a little more on the rule breakers, but also I think I want to dive a little on the family side, David.
Sure, totally. And I was being somewhat sarcastic, since sarcasm is the wit of fools, because I can't imagine we're not going to be doing some of what we just did.
Yeah, we'll do some, but.
Also, guys, I do feel as if I was trying to argue against the establishment at different points, and I hope that's okay. You know, I very much, like, one of the things I've learned in 40 years of having started to run the Motley Fool is it's a motley world out there. So I really am just presenting, I would say, the best rule breaker view of things I can give. But I'm not trying to say all long angle members do exactly what I'm saying all the time. I'm really here to say it's a great big world out there. Make sure you're suiting your own actions to the style that makes sense for you. And I can say to somebody, buy Nvidia, but if they're not going to hold it through a downtime, then it's not a good advice for them, is it? Because they may have lost money At a $5 trillion market cap, it declines to a $2.5 trillion market cap, and they lose 50%, don't keep holding as it goes to $20 trillion in the following 6 years, right? So I'm very conscious of how many different viewpoints there are and how your mindset and your habits are different than mine, and make sure you're listening to yourself.
I'd be remiss to not ask David I know you're not actively picking, but what are you buying today?
Sure. I mean, the answer is I'm DCAing, and I tend to clump my money a few times a year for meaningful stock purchases. My last few stock buys have been, well, March 2024 Palantir. So I certainly wasn't early to the dance, but it's been a fantastic rule breaker. It conforms to the 6 things that I'm looking for, the traits. Rocket Lab has been a wonderful investment this year. I like big opportunities like the commercialization of outer space. So I try to get in early. And by the way, these stocks always look overvalued. As you guys know, Tad lightly references, everybody's like, Palantir's the most overvalued stock, maybe not just of our time, but of all time. And you already know how I think about those things and what that means to me. And I'll take a 9-bagger in 2 years every time, even if it's all about to, lose 50% of its value over time. So I'm basically thinking about rule breakers, and I'm always going there, Sriram. They don't all work out. Those are 2 of my star stocks. I think I've only made like 4 or 5 purchases in the last 2 years. I'm mainly fully invested, and I don't earn as much salary anymore, so it's not as meaningful to me. But anyway, that's a little bit where I am. I was just on the wealth track with Consuelo Mack, which you guys may know on PBS, and she asked me, what is my one stock? Because she always asks that. And I said, and I already mentioned in our conversation, Intuitive Surgical. Because to me, Intuitive Surgical has check boxes along all things I look for, as well as a SNAP test and COLA test, simple-minded tests I use, clear win. And I just see that company just going. It's obviously already much larger at 100 times our initial cost basis, but I think it's going to go larger than that over the next 10, 30 years. So yeah, that would be an example of a company that I love right now.
Well, thank you so much for taking the time to join us here today. This was a fascinating conversation, David.
Thank you, Tad. Thank you, Matt. Thank you, Sriram. This was a delight.
And David, if people want to learn more, dive in themselves, what's the best way for them to kind of follow you and learn more?
I mean, I truly think my book, Rule Breaker Investing, I wrote it so that there's finally kind of a page 1 to page 230 approach, because having worked at the Motley Fool for 30 plus years, I'm never sure what article somebody read that got them started on our site investing. It might have been the equivalent of page 176 was their page 1. So this is an opportunity for me to take 30 years of lessons and reset and just put it all out there. This is my final stock market book. So I'm not a new book every year guy. This is it. And I really wrote it in such a way that it could be understood by a bright 12-year-old or a grizzled 59-year-old who took the time, having saved notes 15 years, to finally write the final book that I wanted to do. So Rule Breaker Investing is the way to get to know me, and rulebreakerinvesting.com is something you can check out. Of course, fool.com is our site. I'm on LinkedIn. Long Angle members, tap Sriram. He might send you my email address. I don't know. I don't know that there's any real need for people to connect with me, but I'm out there. I'm on Twitter at David G. Fool.